$690 per year. That's how much you're losing right now if you've got $50,000 in a savings account earning 2.25%. Inflation in Australia and New Zealand is running at 4.5%, which means every dollar sitting in your account is worth 4% less than it was 12 months ago. Your bank is paying you 2.25%. That's a gap of 2.75% per year. Let me show you the math. $50,000 times 2.75% equals $1,375 per year that inflation steals from your purchasing power. That's $114 per month vanishing. Not from your account, but from your ability to actually buy things. Groceries are up 15% in Australia. Rents up 12% in major cities. A coffee that cost $5 2 years ago now costs $5.80. Your savings account isn't fighting back. It's surrendering. Here's what most people believe: stocks are risky, savings accounts are safe. Here's what the actual numbers show: sitting on cash during high inflation is the riskier play. Let me prove it. Scenario 1. You keep $50,000 in a savings account at 2.25%. After 10 years, you have $51,125 in your account. Sounds good. You've made $1,125 in interest. But inflation averaged 3.5% over that decade. Your purchasing power is now worth $35,850. You've lost $14,150 in real value. Your account grew, but you got poorer. Scenario 2. You move that same $50,000 into dividend stocks yielding 4.5% annually, which is realistic for quality dividend stocks on the ASX and NZX right now. After 10 years, you've collected $22,500 in dividends reinvested at the same yield. Your account holds roughly $72,500. After inflation, your real purchasing power is $50,400. You've actually preserved your wealth and grown it. The difference between these two paths is $14,550 over 10 years. Let's go month by month. If you earn $80,000 per year, and you're keeping your emergency fund in a savings account earning 2.25%, here's what that costs you monthly. That $50,000 at 2.25% makes you $93.75 per month in interest. At 4.5%, the same money makes you $187.50 per month. That's $93.75 per month you could have, but don't. Over 12 months, that's $1,125 you're leaving on the table. Over 5 years, it's $5,625. Over 20 years until retirement, it's $22,500. Now let's talk about the stocks that actually deliver these yields right now in 2024. On the ASX, Telstra pays 4.2% fully franked, which is effectively 6% for Australian taxpayers. Commonwealth Bank pays 3.8% franked. Westpac pays 4.1% franked. These aren't growth stocks. They are utilities and banks that have paid dividends for decades. They are the boring plays that keep working. On the NZX, Meridian Energy pays 4.5% fully imputed. Mercury pays 4.1%. These are infrastructure and energy companies. They raise dividends every year by about 2-3%. A household earning combined income of $120,000, and with $100,000 in savings, is the sweet spot for this strategy. Here's your allocation. $50,000 into an ASX diversified dividend portfolio. Split this across Telstra $15,000, CBA $15,000, Westpac $12,000, and an ETF, like VAS $8,000, for additional diversification. This generates $2,250 per year in dividends, or $187.50 per month. That's tax effective and it's working for you automatically. $30,000 into NZX dividend stocks if you're in New Zealand. Meridian Energy $12,000, Mercury $10,000, Contact Energy $8,000. This generates $1,350 per year, or $112.50 per month. $20,000 stays in a high-interest savings account for true emergencies. It earns $45 per month and provides your safety net. You've now got liquidity, yields, and sleep. The $100,000 household generates $300 per month in passive dividend income. That's $3,600 per year. That's your grocery inflation buffer. That's your ability to absorb a rent increase without cutting back. But what if the market crashes? This is the objection we need to address with numbers. The global financial crisis of 2008 was the worst correction in decades. The ASX dropped 54%. Someone with $50,000 in dividend stocks saw their balance fall to $23,000. Devastating, right? But here's what actually happened. Telstra and Commonwealth Bank cut dividends slightly, but never stopped paying. If you kept your money in the market, within 5 years the ASX recovered and your $23,000 was now $45,000. Within 10 years, it was $85,000. Meanwhile, someone with $50,000 in a savings account during that same period earned $1,125 in interest on that $50,000 and lost $8,750 to inflation. They had $42,375 in purchasing power. The dividend investor, who held through the crash, ended with more actual wealth despite the temporary loss. Here's the action plan. This week, open a brokerage account if you don't have one. In Australia, use CommSec, NAB Trade, or Stake. In New Zealand, use Sharesies or Smart Shares. Minimum. Week 1. Transfer $50,000 into your account. Buy Telstra, CBA, Westpac in the ratios above. Set up automatic dividend reinvestment so your yield compounds. Week 2. Check your current savings account rate. If it's below 3.5%, it's costing you money. Move emergency funds to a 5.25% account. The NAB Max, Westpac Choice, or equivalent pays real rates now. Week 3. Calculate your personal inflation cost. Take your average monthly spending. Multiply by the inflation rate in your country right now. That's how much inflation is costing you per month. That's the problem dividend income solves. You now have a hedge against inflation that works automatically. You didn't need a lump sum. You didn't need to be an expert. You needed to understand one thing. Sitting on cash during inflation doesn't feel dangerous because your account balance looks the same. But your purchasing power is collapsing. Dividend stocks feel risky because the balance fluctuates. But they protect you from what's actually stealing your wealth. Check the pinned comment for a simple spreadsheet that shows your personal inflation cost and the exact dividend portfolio for your situation. Subscribe so you don't miss the follow-up on franking credits and tax-effective withdrawal strategies. This is dollar displacement. Keep what's actually yours.